we are going to compare variable costing, a tool for management. This is Chapter 6 overview. There are two general approaches used for valuing inventories and cost of goods sold. One is called absorption costing. This is generally used for external reporting, and the other is called variable costing. It's preferred by some managers for internal decisions. So the way this works is absorption costing, which we see externally, includes all costs related to the product in the product cost: direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. So the only period costs for them are variable selling expenses and fixed selling expenses. So period costs are related to selling and admin in absorption costing, and product costs are related any cost, including fixed manufacturing overhead, to absorption costing, to product costing. The difference in variable costing is that it only includes those costs directly varying with the product, that is direct material, direct labor, and variable manufacturing overhead. The variable costs, so this is a unit cost computation. We have Harvey Company, which produces a single product. The number of units produced annually are 25,000. The variable cost per unit, direct materials, direct labor, and variable manufacturing overhead, $10. Selling and admin, $3 per product. Fixed costs are manufacturing overhead, $150, and selling expenses, $100. So here's a comparison of absorption costing and variable costing. Now, some of these words and terms may be confusing, but the key is to remember the only difference between absorption costing and variable costing is how they treat fixed manufacturing overhead. That is the only difference. So, absorption costing includes fixed manufacturing overhead in the cost, the unit product cost, whereas variable costing only includes that what varies. See, fixed doesn't vary with the number of products we make, whether we make 10,000 units or 5,000 or 25,000 or 50. This fixed manufacturing overhead, assuming a relevant range, does not vary. The per product cost does vary with the number of units that we have. So income comparison, let's make an income comparison for absorption costing and variable costing. Let's assume the following additional information. 2,000 units were sold during the year at the price of $30 per unit. There was no beginning inventory. Let's compute net operating income for both absorption and variable costing. Okay, so absorption costing. Pretty standard, we take the sales number, 20,000 units, times the $30, right here. That's 600,000, less the cost of goods sold. So how we get there, beginning inventory, plus cost of goods manufactured. This $16 includes, in absorption costing, manufacturing overhead. So times the 25,000 units that we manufactured, that's 400,000. The goods available for sale are 400,000. We have an ending inventory of 5,000 units times the cost, 80,000. So our total cost of goods sold manufactured is 320. That gives us a gross margin of 280. Then we subtract the selling and admin expense, the variable and the fixed, to get a net operating income of 120,000. Fixed manufacturing overhead is deferred in this inventory. So basically we've deferred fixed manufacturing overhead, which is happening at $6 per unit, right? The fixed manufacturing times the 5,000 units that are sitting in ending inventory. So we've deferred $30,000 worth of cost in absorption costing. Now, variable costing includes only variable manufacturing costs, and all the fixed manufacturing overhead expense is put right here. We do not defer any in inventory. So in this one, we have $90,000, which should be correct because we deferred 30,000 in the last. And this is going to show you how we got there. So under absorption costing, we had fixed manufacturing overhead up here. Under variable costing, we had it as a period expense. So the whole 150 came out, whereas ending inventory was sitting on some of this money. We can reconcile the difference between the absorption costing and income as follows. So if you get the variable costing net income, you add fixed manufacturing overhead costs that burden inventory. So basically ending inventory times your fixed manufacturing overhead cost per unit, and that will get you to your absorption costing net income. This problem has extended to show you what would happen if you did a second year. Well, in the second year, you're going to use the inventory, right? So, absorption costing. Let me go back to the previous one. Okay, so we produced 25,000 units, we sold 30,000 units, and we have beginning inventory of 5,000 units. Our unit sales price is $30. Direct material is 10, this is the same as before. Selling and admin is 3, manufacturing overhead is 150, and selling and admin fixed is 100. So under absorption costing, we have the $10 plus the $6. So our unit cost is 16 instead of 10. Since the variable cost per unit, total fixed cost, and the number of units produced remain unchanged, the cost computations remain unchanged. So beginning inventory, valued at 80,000. Add our cost of manufacture. So our total goods available for sale, less the ending inventory. So now we have 480,000. Our gross margin is 420 under the absorption costing. Then we take away selling and admin expenses for a net operating income of 230. Fixed manufacturing overhead was released from inventory. Basically, that $5,000 that we deferred was now released, and it's in here because we don't have any ending inventory. We sold everything we had plus the beginning. So variable costing on this one, right? We have the fixed overhead expense, which was fixed. We have our beginning inventory plus the cost times the $10 instead. So our goods available for sale are 300,000, and our contribution margin is 510. We have a higher contribution margin because we're not putting fixed expenses into that, right? So again, we can reconcile this. So all we're doing is moving the fixed manufacturing overhead. It's being absorbed into inventory, ending inventory. So this is a good way, absorption, to decide what to do with the product, because you could actually end up with a break-even number that isn't correct because you're including fixed manufacturing overhead. So the first period we had 120 and 230. The second period we had 90 and 260. In total, we got to the same number, but it's just depending on where the inventory was sitting. The key difference is, the key highlights, the relationship between products and sales. Units produced equals units sold. If there are no changes in inventory, then absorption and variable costing will be the same. If their units produced are greater than the units sold, so if you have an increase in inventory, absorption will be greater income than variable. That's because we're deferring some of that cost. And if we produce less than we sold, and we have a decrease in inventory, absorption will actually be less than variable. So absorption costs include changes in inventory, whereas variable costs does not take into consideration changes of inventory. Absorption costing doesn't dovetail well with the cost volume profit analysis that we learned in the previous chapter. And it doesn't support decision-making ability, because by taking a fixed manufacturing overhead cost and then dividing it and making it variable, potentially we could produce positive net operating income even when the number of units is sold is less than the break-even point. And it can lead to faulty pricing decisions, whether we keep or drop a product. So it's not a good idea internally for decision making to include fixed manufacturing overhead in your variable costing. So the advantages of variable costing, also called direct costing. Management finds it more useful. It is consistent with the cost volume profit analysis. Its net income, operating income, is much closer to net cash flow. Very important in decision making. Cash is king, right? Consistent with standard costs and flexible budgets. This is very important. We'll get to flexible budgets and budgeting later in this um, cost accounting, but it's very important. Easier to estimate profitability of products and segments. We want to know, is that product, so we have a building, right, which is for the factory, and we have multiple products in there. If we divide that manufacturing overhead that is fixed, the building cost, over that product and allocate it in a variable way, it doesn't give us a real idea of the profitability of that product before the fixed cost. Profit is not affected by inventory changes, and the impact of fixed cost on profit is emphasized because then you can see the actual impact of fixed cost. So what is your contribution margin, and then how much are you spending on fixed costs? It's much easier to see that with variable costing. A lot of companies nowadays in manufacturing use lean production, which means they're not sitting on a bunch of inventory. So therefore, the differences between variable and absorption costing tend to disappear because, again, if units produced and units sold are very close, you won't see much of a difference. The difference only lies in the inventory between these two costing systems. And you can watch a video on Chapter 6 examples creating income statements using both absorption costing and variable costing. These are examples from Chapter 6. This is talking about variable costing and absorption costing. So exercise 6-8, variable costing unit, product cost, and an income statement and a break-even. So, Chuck Wagon Grills Incorporated makes a single product, a handmade specialty barbecue grill that sells for $210. Data for last year is listed below. The requirements of the problem are: assume that the company uses variable costing. Compute the unit product cost for one barbecue grill. Assume that the company uses variable costing. Prepare a contribution format income statement for the year. 3. What is the company's break-even point in terms of number of barbecue grills sold? Alright, so here's the information given from last year. The very first thing that we want to do is determine the product cost. Variable costing product cost. And let's just do this. Part 1. Okay. So, in variable cost, we are going to include direct materials, and that's $50. And we are going to include direct labor, and that is $80. We are going to include variable manufacturing overhead, and that is $20. And for the variable costing, this differs from absorption costing in the fact that we are going to include the variable manufacturing overhead. So this is our variable product cost. So we're going to total these. And our variable product cost, unit cost, is $150. So this includes all the variable expenses directly related to the product. The next thing we're going to do is make a contribution margin income statement. This is similar to the ones that we've made in the other chapters. So, variable cost contribution margin income statement. Okay, so now we need sales, and sales will equal 210 is our selling price. It was given in the problem, and we sold 19,000 units. Then we must list out our variable expenses, and variable is variable cost of goods sold, and this is equal to units sold times variable product cost, what we just figured out in part 1. Okay. we sold 19,000 units equals the number of units we sold times our variable product cost. We also have variable selling and admin costs. And that was given in the problem. That's $10 per unit times the 19,000 units. Right. So our contribution margin is our sales minus our total variable expenses. Then we have fixed expenses. And the fixed is fixed manufacturing overhead. And that was given up top as 700,000. That's part of the problem. And then we have fixed selling and admin. In the past, we've broken out selling and admin, and then the actual cost of the product. Here, we're including fixed overhead as part of the fixed expenses because this is a variable cost contribution statement. So our fixed selling and admin, we're going to total these. This is our total fixed cost. And then it should be net operating income. Fixed cost. Equals. We have a negative number here. So part 3 is to actually figure out our break-even point. This is from the previous chapter. Break-even point in units. We can do this by taking the selling price, which is 210, right? And then the variable cost per unit, which is 160 up here, okay? And our contribution margin per unit equals our selling price minus our variable cost. So each unit contributes $50. Now, the formula for this is unit sales to break even equals fixed expenses divided by unit contribution margin. So our fixed expenses are totaled up here, $985, divided by our contribution margin per unit. These aren't dollars, these are units. So we must sell 19,700 units to break even. Now the next exercise we're going to cover is 6-9. This is using the same data as 6-8 from Chuck Wagon Grill, but now we're going to do the absorption costing. And so we're going to see the difference between the two. So again, the units produced, the inventory being sold, this is all given in the problem. The variable cost. This is all the same as exercise 6-8, but now we're going to do absorption costing. So requirements. Compute the unit product cost for one barbecue grill, assuming absorption costing, and prepare an income statement. Alright, so part 1. Now we're going to calculate the absorption costing, unit product cost. So in absorption costing, we include direct materials, equals $50. We include the direct labor, equals $80. We include the variable manufacturing overhead, which is $20. We don't include the variable selling expenses, but we do include the fixed manufacturing overhead. And the way we find a unit cost, we take the 700,000 fixed manufacturing overhead divided by the 20,000 units. So equals 700,000 divided by the 20,000 units produced. All right. So this is $35 per unit, the fixed. So now our absorption costing, unit product cost equals the total of all of these. So that's 185 per product. Now, part 2, create an income statement. Alright. So we have sales equals, we sold 19,000 units, although we produced 20,000. We have 1,000 remaining in inventory. Oops, I added an extra zero there. 210 is our selling price. So we have sales, then we have cost of goods sold. And our cost of goods sold is our absorption cost per product times the actual number that we sold. Okay, so then we get our contribution margin. Okay. And then we have selling and admin expenses. And this is equal to variable selling and admin times units sold plus fixed selling and admin. Okay. So we have our variable selling and admin is $10 per unit. We sold 19,000 units. Plus we have fixed selling and admin costs of 475,000. Net off. Oops. Okay. So now we must get to our net operating income. And it's 0, right? Okay. One more thing. So that we understand it, right? Alright. So, this is the difference between the absorption costing, we had 0 when we made this, and the variable costing, we had minus 35,000. And that is because the variable includes fixed manufacturing overhead for products that are sitting in inventory. The absorption costing puts it in inventory. So that's why there is a difference.